For the last 2 years, SAB121 forced banks to treat customer assets as liabilities on their balance sheet, making custody a regulatory nightmare. Now, that requirement is gone. Banks, exchanges, and stablecoin issuers are celebrating. But there's a problem. Without this rule, something critical is missing. And if the industry doesn't find a way to fix it, we could be setting ourselves up for a bigger issue down the road. Stick around because by the end of this video, you'll see exactly what needs to happen next. If you stay to the end, you can grab a copy of the latest edition of our DGens Digest, your secret weapon for mastering crypto taxes, staying out of trouble, and keeping more of your money. Welcome to TNF Takes, the go-to spot for crypto companies and on-chain organizations. Before we dive in, make sure you like and subscribe to continue getting top-tier content for your crypto company or on-chain organization from industry experts who have been around the block. I'm Noah Buxton, and I'm here with Jeremy Now and Nick Ward from the network firm. We're here to help you establish trust, build efficient crypto operations, and stay ahead of the curve in an ever-evolving industry. Guys, welcome. How are we doing?
Happy to be here. As you can tell, I'm rocking our new TNF swag from our merch store. Glad we were able to fire that up just in time for Christmas. Did you guys get yours in the mail yet?
Expecting mine Tuesday, so this will be my last week without it.
Yeah, same. You can see I'm supporting my daughter's school here today, and Phil Knight. But yes. TNF in spirit.
Nice. Well, we'll be expecting your new swag next week for the TNF Take.
You can hold me to that. Yeah, anyone else is also welcome to check out the TNF merch store. There's some fun stuff on there. Get yourself some TNF gear if you're a supporter. So guys, in 2022, the SEC introduced SAB121, and this rule fundamentally changed how certain companies reported customer crypto assets. So if you're in the crypto space, in the accounting space, you almost certainly heard about this. And exchanges, stablecoin issuers, payment processors, dedicated crypto custodians, and yes, even our TradFi friends, the banks, were required to recognize these customer assets on their own balance sheet. That's it in a nutshell. But this created significant capital requirements for banks. And this really, I guess, effectively blocked banks from offering crypto custody. So while intended as a safeguard under the former administration's SEC, the rule and PCOB, the rule faced really heavy backlash, right? Critics argued it unfairly restricted financial institutions, banks, while also giving non-bank custodians this competitive advantage if they were not a public company, right? And reporting under this rule. So now this is a major shift, right? It comes with sort of a tidal wave of changes coming from executive orders and other proposed legislation that we're going to see. And this rule comes under a new interim commissioner at the SEC, Commissioner Ueda, and they've walked back SAB121 by issuing SAB122, removing this reporting requirement altogether. So what does this mean, for crypto adoption? Can we, are we unbridled now? Was this the change we needed? Or on the other hand, is this change introduced like an even bigger issue? So let's break it all down. I know you guys know the ins and outs of this, so let's hear more. Maybe Nick, go for it. Like, to set the stage. Like, what is this thing we're talking about?
Let's back up to SAB121 just to be ultra clear on what that was. So in April of 22, the SEC somewhat surprised the industry with SAB121, and I say surprised. I think Jeremy, you'll get into this a bit, but the rule came out out of nowhere, essentially. When I say out of nowhere, there was no comment period or introduction to it of, hey, we're thinking about this. It was, here it is. And so SAB121 was introduced, told public companies specifically, because that's who it was addressing, that after reported periods after June 15, 22, they'd be required to report all customer assets and liabilities on their own balance sheet. So as you mentioned, this affects crypto exchanges, stablecoin issuers, even payment processors. If they're holding assets in transit on their way, they would have to report those liabilities on their balance sheet and then a corresponding asset with it. So Coinbase being the most prominent example of a public company that had implemented this, once, I think it was Q3 of 22, you saw on their financials, they had a big customer assets and customer liability. Those matched, but those were meant to capture all of those cryptocurrencies that they were holding on behalf of customers.
Awesome. Yeah. And this SAB is a staff accounting bulletin. So that's the other thing that is kind of interesting here is that you'd think, wait a second, a staff accounting bulletin, that sounds like it's going to have very little weight. I don't know. You walk
Sounds
into
benign, right?
the kitchen at the office, there's a bulletin. Okay, great. Didn't change my life, didn't force me to do anything. But the natural effect of these staff accounting bulletins is that they do carry quite a lot of weight, right? Because they are, they're not regulation, they're not law, so to speak, but this administrative interpretation is directly requiring the company to report in a certain way. And it also has this effect on auditors, right? Because now auditors need to look at the books, look at the accounting treatment in a certain way. So pretty strong effect, actually.
Yeah. And what effectively this did, right, is that like for exchanges and custodians, they of course, would need to report. They have an additional reporting requirement. But for banks, this really affected their ability to create or to offer crypto custody services, because unlike crypto custodians or exchanges, banks have capital requirements. So this effectively increased the capital requirements for banks to be able to offer these services. Under Basel III and US banking regulations, banks must hold tier 1 capital against balance sheet liabilities based on a risk rating. So tier 1 capital is typically short-term treasuries, reverse repo, these highly liquid instruments based on the amount of assets and liabilities they hold on their balance sheet. So when this was now required to be included, now their tier 1 capital requirements went up. So since crypto is deemed high risk, they were assigned a risk rating of 1,250%. So that effectively meant that banks would be required to hold the full value of the crypto that they held as custody on behalf of their customers as extra funds on their own balance sheet, right? So if you held $1 billion worth of Bitcoin on behalf of customers, you need $1 billion worth of tier 1 capital. This effectively, limited, or you would have to have huge,
or even more. Yeah.
Yeah, or even more. Yeah. So you'd have to have huge excess capital just to be able to offer these services. Traditional custodianship of like stocks or bonds, it did not require this. And that's why banks can provide these services without these excess burdens that would have been applied to crypto. So this was a huge, this is why it effectively locked out banks. And it actually, for like BitGo and the custodians of the world, it kind of created a moat for the interim period or Coinbase custody. So that's why there was a huge scrutiny. It effectively impinged on adoption of crypto, especially at the TradFi level.
Yeah, there's a lot there. Maybe I want to back up real quick to the public company requirement too, because if you don't work in accounting every day, if you're doing a startup or working in a larger, even at a crypto exchange, let's say, this might not be immediately known to you, but these requirements are technically for public companies, right? Broker dealers and issuers, public reporting companies that have an SEC reporting requirement. And so, of course, there's a few of those in the crypto space, right? Largely it's miners. Now we have some publicly traded products, ETFs. And as you mentioned, Coinbase, right? As a public reporting company that would have this sort of obligation. But there's actually this trickle down effect that happens, right? So either, let's say you have a mid-size or larger company that's preparing to IPO or wants to prepare itself for a public option in the future. Well, they're going to start to early adopt, right? These sort of the rules that technically apply only to public companies. They're private. They don't have to report to the SEC now, but they're preparing themselves to. And then also banks, right, just got swooped in here because many of the top banks essentially that would have wanted to serve the crypto space or crypto custody function, they're either directly an issuer with the SEC, right? They're publicly traded banks, or they have, based on their size and through the Office of the Comptroller of the Currency, their other reporting line have yet now an SEC reporting requirement because of their size. So it kind of drew in all the top players that arguably would be good crypto custodians.
What was interesting about this too is like, this almost seemed like it was the SEC unilaterally doing this at the direction of, maybe the administration. But there were like the trade associations on behalf of the banks, like the Bank Policy Institute, and even regulators like the OCC opposed and voiced serious concerns that if it unfairly restricted banks from operating these services. So, like, it wasn't without controversy, even within its own industry, not just in crypto, you know. But there were, there were some benefits to this that often people don't mention. And that was transparency. Right now, the customer assets and liabilities were disclosed on these companies' balance sheets. And I think that's a good thing. You can see how many customer assets and liabilities they actually have. What was the makeup of those customer assets and liabilities to a certain extent, right? So you can actually get a little bit more detail, and it would be incorporated in the financial statement audit procedures. So it would have much more scrutiny during an audit. So ultimately, I did think it made for a safer crypto financial system, if you will. But of course, there was these consequences that also infringed adoption. So it really was a give and take here with this original rule.
Well, no,
Yeah,
that's the key.
Go ahead.
Noah. Well, I was going to say, Jeremy hit the nail on the head there, where most of the industry agreed this is great, but this is why the SEC rolling it out the way they did was a problem, because they didn't give the industry a chance to respond to the rule to say, hey, this is good, but have you considered the secondary consequences, so that they could specify, okay, agreed, that makes sense. Let's remove the additional capital requirements, just like we do for other traditional assets, with still keeping the spirit of the rule, which would have been a good thing. But because there was no comment period, it rolls out, it's effective as written, and as you laid out, all of these secondary effects took place.
Yeah, and this was first, SAB121 was first challenged by this, disapproval of an administrative rule procedure. I'm going to forget the exact name, right? But this was actually the first bipartisan vote on crypto legislation that went through both House and Senate, right? It was not signed by Joe Biden into law to repeal SAB121 before he left office. But this has now been effectively repealed or replaced by SAB. It is a bit of a like baby with the bathwater moment, sort of like, oh, it all goes out the window. And that's a bit unfortunate, right? That's what we want to kind of talk about today, is the key implication here. And this is a little bit of a nuanced take, right? I think most in the crypto industry say, yay, SAB121 is gone. We think that leaves a little bit of a vacuum. There was some progress here. I talked about that trickle down effect to private companies, right? Getting these customer assets and liabilities to be more transparent, generally speaking. So, although this rule, effectively made it impossible for banks to hold crypto for clients, and that would have been a good thing. Sure, we've got more, institutional sources of custody services in the space. Arguably that's good. On the other hand, we now have a vacuum where there's going to be less transparency, certainly at the public company level, and also the trickle down as well. So yeah, I think that's kind of it in a nutshell, is that, now let's get into that. Maybe let's tease that apart, right? Like, what is that vacuum look like? Go ahead.
Yeah, and I think, so SAB122, so let's enter what was put in by the Trump administration. So yes, it did rescind SAB121, and it applied for periods beginning after December 12th, 2024. So essentially, we should see this implemented in financials issued coming up. Usually public companies are getting their financials out in February, so we'll look forward to seeing how they actually implement it. But SAB122 did rescind the requirement of SAB121, so they no longer have to adopt and essentially put those customer assets and liabilities on the balance sheet. It did point to the contingent liability rules. So for all the non-accountants, this is essentially a contingent liability requirement, is a company to assess, do I have potential for future loss off of an asset that I'm holding? Usually that's not the case with a one-to-one like kind, custodian, where, hey, I just have to give the Bitcoin back to the customer at some point. There's not a loss to my business, so therefore it likely doesn't go on it. SAB122 does reference that companies should still assess the risk and, include relevant disclosures. But again, those rules are very much, the company could just write a paragraph and say, hey, we custody on behalf of clients, that we could get hacked, or there is a risk of loss if we were to mismanage the keys or something like that. But it goes well short of, actually valuing all of the liabilities to customers and putting them on. So that vacuum you're talking about likely will be there now. And so we're back to, all right, how do we get good transparency for these companies?
And if we think about like, okay, just to make a fine point on it, so that means public issuer exchanges, banks, custodians, stablecoin issuers, they no longer have to have those customer assets and liabilities on the balance sheet, right? Those are off, they're no longer visible on the financials. And that effectively means there's going to be less scrutiny, right? They're going to do a contingent liability assessment, but there'll be less scrutiny on the overall balances of the customer liabilities during an audit process. So that's a net impact. For the banks, this is effectively going to uninfringe them to be able to hold or offer these services because they no longer will have that tier 1 capital reserve requirement against this custody crypto. This is going to remove a huge barrier for them. So I think that's overall a net good. For exchanges that are not banks or custodians that are not banks, I think this is going to effectively make the reporting and the audit process become easier in some respects because there's just simply going to be less scrutiny on the customer assets and liabilities. But this comes with a downside that there's less transparency and scrutiny for the public or for the customers of these companies, which we think is a net negative. There's these good things, there's these bad things. However, there is a way that we can fill this gap. And maybe with that, Noah, like you've had ideas, we've thought about these things for a while. What is the way that we can actually, repeal SAB121, but also give the public the transparency it needs to be able to confidently use these services in the space?
Yeah. Re-enter proof of reserves. The reemergence. No, I don't think it ever really went away. I think even under SAB121, proof of reserves was still relevant, right? Because if you look at an issuer, a quick example of like a Coinbase, right? Look at the financials as a customer on an annual basis or a quarterly basis and tell me if you can reasonably assess whether Coinbase has sufficient custody of customer assets to meet outstanding liabilities. You have to do some accounting there. You got to look at this off-balance sheet schedule, this audited footnote. You'll see some of it is reported in like kind and some isn't. Then you have questions about that. So it's still it's still not directly transparent as frequent. Now in private companies, like again, I say it's still been relevant because private companies technically didn't have this SAB121 requirement anyway. That's why it's still relevant, right? This is still, POR is still a very focused, narrow attestation tool that a CPA can perform to more clearly show customers and other stakeholders a point-in-time assessment of customer assets and liabilities and their like kind, and whether they're in like kind. So this is available to both public and private companies. That's important to notice, to note. I think this is something that public companies certainly should adopt. And I think it's also important to note, like, proof of reserves is not a replacement for audits. We've never thought that it was a replacement for audits. It's a powerful, focused supplement to existing audit or financial statement audit and other third-party assurance or compliance reporting. So, we think this also is a differentiator. Certainly it can set players apart in the market if they show this level of transparency. And it opens all kinds of doors to innovation too. So there's, of course, the real-time potential here. We've demonstrated that in the real world in practice with a large ETF or ETP issuer, right? That you can provide effectively real-time transparency or daily transparency even. And also, even in the slower version of this proof of reserves that we do, right? It's a quarterly or a semi-annual. That's still better than an annual financial statement audit in terms of its frequency. And arguably it's better in terms of its focus as well, right? So more frequent, more focused, and by the way, also accessible to customers, which private company financials are not. So we think this overall provides like a level of confidence. It's there's some technicalities around whether this is quote unquote assurance under the standards or if it's a non-attest or no assurance engagement. We've done videos about all that stuff. That's important, right? But at the end of the day, it's a confidence signal of some sort. Trust is in the eye of the holder, as we like to say. And so, in a proof of reserves engagement, as long as the reader of this report is knowledgeable and understands what's in the four corners of the report, we think that it's a really good transparency mechanism that in this vacuum of now SAB122 still remains super relevant.
And what is also interesting about this is that proof of reserves doesn't seem like it's going away at the regulatory stage, because when we see the strategic Bitcoin reserve requirements, And even in the Proof Act, what was that, maybe 18 months ago now introduced, there were proof of reserves requirements in those proposed bills. So it seems like, regulators at the state and federal level are both looking at this as being a potential vehicle that can fill the void, right? That's going to be left by these financial statement audits. And I'm still looking for the day that maybe the regulators or some of these governing bodies, they'll look at maybe implement and think about a Merkle tree, right? To enable customer verification as part of the proof of reserves too. I know in Wyoming, they actually do have a Merkle tree proposed rule in there. Right now it's opt-in, right? But it's going to show that this is slowly but surely becoming understood.
I love you brought that up. Sorry, can we dig into that real quick as an aside? Because I said it opens the doors for innovation. I talked about real time, and then I forgot to talk about this piece, the Merkelization of customer liabilities. So, why is that innovation? Why is that important?
Yeah, well, I mean, what effectively happens if you're using a Merkle tree during your proof of reserves is that instead of just reporting on the customer assets and customer liabilities, what you actually do is that you report on those two things. But with the customer liabilities, you can essentially pseudonymize them and expose that list of customer liabilities to the public. And now each user can go and check to make sure, hey, was my account included in that list of liabilities within the proof of reserves? If so, I feel pretty good, right? My balances were counted. If not, hey, was this exchange or was this custodian cheating? Were they trying to understate their liabilities? So a Merkle tree can act as this public way of checking the custodian or the exchange. And it's very unique. We haven't seen this in any other audit or assurance vehicle or attestation vehicle in the world. And it's really a crypto native way of doing this because it was, came after Gox and the industry needed to find a way to protect itself. So now it's something that it's almost like AMMs and Uniswap. It's like, hey, there was this innovation in crypto, and now you can apply it in so many other ways in the financial system. So I want to see it get there eventually, and we're kind of seeing it in some proposed rules already.
So Nick, is it going to be? Is this going to be something we're going to see bleed into TradFi? The Merkle
potentially. I think what's interesting, or maybe to help contextualize this to our listeners, is in the traditional world, like this check of liabilities, or if I'm issuing a financial statement audit, I'm doing all that before I issue my report, and I'm doing it at a very sampled basis, right? Like I might send 10 customers, 50 customers, something that says, hey, my client has a loan to you. Can you confirm this was the balance at year end? But it's not real time and it's not available to the public. So to your point, I think this is an awesome innovation. I think one of the further steps I'd like to see it take is where exchanges or custodians that issue the Merkle maybe start to report on, hey, just so everyone knows, here's how many people have checked the Merkle from last period, right? So users can get even more confidence in, okay, wow, 50% actually confirmed they were included. There were no issues. So this could be pretty accurate. And then, I love to think beyond that of in bankruptcy scenarios or some kind of fraud situation, maybe these proof of reserve reports can actually give the investigators that have to come in and assess the mess after. Hey, now we've got some point in time snapshots where we could see potentially what was legitimately there and start there in terms of when we get to the point of paying out creditors. Or yep, there was when the fraud occurred. We could see, maybe there were numerous customers that indicated the Merkle was incorrect or they were missing. So it's just a net positive in terms of information that's available. And, who knows the secondary effects, how far they.
Awesome. I love that last one too. That last idea about, looking back at these reports for another yet totally different, but yet important reason. And I'll say one more thing before we wrap up, because you mentioned it, is sampling, right? So we've kind of talked down a few layers about why we think proof of reserves remains important, remains relevant, even where there is financial statement audit reporting, even in the vacuum of 122. However, when you talk about sampling, I guess let's imagine the SAB121 regime is still in effect, right? And you've got customer assets and liabilities now on the balance sheet. Let's assume they're material, right? This is what the auditor does. Goes down and says, okay, well, what's my materiality? Okay, this account is material. Okay, let's assess kind of the risk within that account. Let's determine how we're going to sample this. It's never started from, well, we're just going to test the whole thing, right? We're going to test through and through. I want to be careful because it's always important when talking about audit approaches. They're different for different firms and there's best practices, and certainly auditors could do more or a little bit less here and there. And that could be completely legitimate to get to their opinion, right? They use the standards to get there. However, it's generally true that these would be sample sizes that our listeners might be shocked about. And so this is a thing with proof of reserves that you have to talk a few layers down to get to, but is that our general approach to, let's say, a point in time quarterly proof of reserves for crypto exchange or custodian is going to basically be 100% testing of the in-scope assets and liabilities. So tokens and related entries on customer accounts for those tokens in like kind. So you put together, if not 100%, vastly more sampling, right, or testing, in addition to this like kind assessment of assets and liabilities, right? Not, oh, we owe customers $1 billion and we have $500 million of our own exchange token and then some other crypto commingled, right? These are very important considerations. So yes, proof of reserves remains relevant. Maybe we'll wrap it up there, guys. This has been, I don't know exactly how many minutes, but a good treadmill run or a good walk for somebody, hopefully listening along, or not too much out of your day to listen to, but hopefully provided some value here. So in recap, SAB122, definitely a move to cheer in some regards. It's a benefit to crypto adoption. Definitely is going to unbridle the banks to start offering crypto custody services. And I think that's good for institutional adoption, right? Been long awaited. However, it does introduce a significant and new risk, right? As customer asset transparency is reduced. And proof of reserves remains a relevant tool to bridge this gap. So we hope to see additional adoption there. If you have any questions about all of the nuances and the ins and outs of either these accounting rules or proof of reserves, we invite you to reach out. And thanks for sticking with us. You can also, in the description below, check out a link to the DGen's Digest. Slightly different topic, but all about personal tax and business tax filings. I get all of the tips and tricks you need to stay out of trouble and keep more of your own money. So this is another TNF Takes. Guys, thanks for joining me again on a Sunday morning to record some great content.
Thanks, guys. Great stuff.
Thanks, guys.